Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about this subject, the importance of planning and investing in your 60s. Now, if you're not in your 60s and you're in your 50s, this guide is still going to be relevant for you because it's really about how do you prepare for retirement, what are the key areas that you have to be focused, super hyper focused on to help you to be in a position where you're going to have a stress-free retirement and really start planning and enjoying your retirement. So as I go through the different points, I think there are 9 different points. I'm not going to go drill too deeply into them because I have this huge library of videos for you to watch in my YouTube channel. So I'm going to be covering them in sort of like the 30,000 foot level. Any of the subjects go deeper in by watching the other videos, and I'll point them out when we get to those subjects. So without further ado, and by the way, again, thanks for joining me. Put your comments below. I love reading your comments and video suggestions. And let's get into why you're here today. Let's look at the first one. So we're going to talk about step 1 in how to prepare for retirement and trying to understand, what I'm thinking is that you're sitting down either by yourself or you're with your partner and you're trying to figure out, okay, well, we got to think about retirement. This is important now. What are the steps for you to go through in order to get to a point, if you're not working with an advisor or even to prepare working with an advisor, what are the steps that you need to go through in order to figure out, are you ready? Are we going to be ready? Are we going to be okay for retirement? So these are the 9 steps that you have to go through in order to make sure you're ready for retirement. So the first one is understanding your retirement income sources. This is really key to understanding. So think of it like a business, okay? A business only survives by the cash flow coming in and controlling the outflows going out. Your life is the same. Controlling what are the cash flows, so what are your income sources and how much money you're going to be spending. So the first one is, where are the income sources that you're getting? What kinds of income sources are there? Are there any restrictions on some of those income sources? So meaning there might be some income sources that start at a certain time. For instance, CPP, the earliest start date is age 60. So that's one restriction on an income source. But the question is how much of a CPP you're going to get. So you get my meaning. This is really important for you to start to identify what are the different income sources you're going to have. So let's look at some of those income sources. CPP and old age security, having a private pension plan, having an RRSP or RRIF account, a spousal RRSP account. Got to be careful about when to do withdrawals out of a spousal account. You may have a lira that has to be converted to a LIF, and then 50% unlocking if you're in a part where you can do unlocking. Stock options, there might be restricted stock options, call those RSUs. You could have maybe too much stock and trying to figure out what to do with the stock. Having dividends, whether they're eligible dividends from a non-registered portfolio that you might have going on. Company dividends, meaning you are a business owner and you've got a corporation and you're paying yourself dividends. Having some rental income, your own employment earnings. Some of you may still be working and going to be retiring soon. Some of you are retired and are still working. And so there's that employment income to be caring for. And then you've got some insurance. Now, I talk about this in my channel about using whole life insurance, having a large non-registered account and hiding some of that money in insurance and then using the cash value later on in life. So when do you integrate that into your plan? The next is reviewing your retirement expenses. So the first one was the money coming in, and the other one is understanding the money going out. So let's look at that. So your pre-retirement versus retirement. In this planning document that you see on the video here is a questionnaire that I send you. When you invite me to do your plan, I send you a questionnaire, you fill it all in, and in the last 2 pages has really like a not a balance sheet, but a budget, if you will. And you list out everything you're spending money on. If you need help with this, some of you have Excel spreadsheets, but you list out all your pre-retirement expenses, and then beside it is the retirement expenses. You can see where in some instances you'll actually not be spending as much money in certain areas and then spending more money in other areas. So it's really helpful for you to start to visualize how much money you're going to be spending in which areas of your life and how that spending might change over time. So here's an example. Besides your regular lifestyle expenses like property tax, groceries, putting gas in the car, buying some clothes, going out for dinner, those kinds of normal lifestyle. Then you're going to have travel. You have to pay your taxes, renovations. You might be giving some cash to some of your kids if you've got kids, replacing your car 2 or 3 times throughout your retirement, and then healthcare. Where are you going to live? How are you going to live? Are you going to need to do any renovations to your home in order to live in that home, or do you just move somewhere else? So all those have to be accounted for, and they go into your plan when we do a plan. Okay, the third thing is inflation. When I do plans, it's usually 2.5% that I set as inflation. If you want a higher number, we can do a higher number. But inflation is really a big concern. We remember seeing that a few years ago when all of the supply chains were disrupted, and having a lack of something drives inflation. The cost goes up, right? And for a short period of time, we had some pretty hyperinflation numbers, and those numbers have come down now. But it does impact your ability to really protect your purchasing power, right? So we have to be aware of when we put in these expenses that we're also making sure they're inflation adjusted, so that as you go through your life, you got to make sure that as you put in your travel budget of $10,000 a year, that travel budget has to increase with inflation. So you have to be accommodative towards that. And we also talk about sort of using a bucket strategy. You may have seen this video up here. I can't remember which side of the screen I have to point to, but you can reference this 3-bucket video that talks about how to structure your investment account so that you can be not too worried about market volatility and inflation as well. And the money that you have in each of these buckets really reflect both your need for income and also like your time horizon. So for instance, what you're spending money on every day, like groceries and clothes and paying utilities, that has very little volatility. It's a 1 year to a 3 year kind of timeline where you need to make sure you have access to that money and have it not fluctuate. You need to make sure if you have $10,000 in your checking account today, you want $10,000 in your checking account tomorrow. The other 2 buckets really are different timelines that you can invest your money a little bit with a little bit more risk because you need it to grow. And certainly you don't need all your money in 1 year. You need your money to last throughout your retirement. So here's an example of inflation. At 2%, that green line, blue line is 3%, and 5% is in the red line. So you can see over a period of time at $500,000 invested at 7% rate of return over a 20-year period, you can see the impact of inflation. If only at 2%, you would have $1.3 million, and then you're cutting about $300,000, $200,000 off just by going 1% difference between the 2% to the 3%. And having a 5% inflation rate, wow, that's just taking so much of your money away. So you can see that over your lifetime, most people live in retirement around 28 years. So in that 20-year period, you can see how inflation really does play a key part. Here is just a snippet of a financial plan, and we're only looking at the expense. If you looked at the full screen, you would see the expenses and the income and the tax rates and then your financial assets and real estate assets. Here we're just looking at your expenses, and to give you some insight as to how we cover this off when we're doing plans. You can see on the left-hand side your age, and then you've got this expense column. It's called real and nominal. The real is what this couple feel that they want to spend. It's their intention to spend $92,000 per year of after-tax money. You can see actually it's static all the way through until about, age 75? And then they drop it down to 20. Why? Because they're going to move into a lifestyle community, and that lifestyle cost goes up, and you can see there's a column there for that where it's $143,000. $143,000. But we know that lifestyle communities is about, say, $60,000 to $70,000, maybe even $80,000 a year right now. But adjusted for inflation, so between 2039 and then 2053, by that time, that $80,000 expense is now $143,000 expense. So we've already adjusted the lifestyle community spending for that as well. You can see the car expense goes up, the travel expense is going up with inflation, and that nominal column that you see there, that's the $92,000 adjusted for inflation. So you can see their spending is going up with inflation when we're protecting their purchasing power all the way through their retirement. That's what you can come to expect when we do a plan for you. But maybe your line items are different. Maybe you've got some other things in here that are not like, we do have a renovation cost. So there might be some other things in here that you also want to include. Okay, the fourth item is always one of the biggest questions we get is, when do I start CPP? And I've got this video up here of me taking a walk through the bush. Highly controversial video where you were all, had a lot to say about what my thoughts are. Remember, these are my thoughts on my CPP when you watch that video, not on your CPP. And so the question is, taking it early, taking it on time at 65, or taking it later and deferring to age 70. Your full CPP is age 65. If you take CPP at 60, you're going to have a 36% permanent reduction of your CPP. You take it later, you're going to have a permanent increase of 42% at age 70. So there's some merits between taking it late and penalties for taking it early. Here is another sample plan for you to see how do we address CPP taking it early and taking it late, and what are the differences between two plans. So here we have a plan, as you can see, where we're taking CPP at 65, and you can see just some nuances to this plan. There's a couple, and they're beginning CPP at 65. If you look at the tax rate column and the effective tax rate column, and then to the right of that is the RRSP in the yellow. That's the meltdown of the RRSP. Sometimes it's going to be just a RRIF minimum. Sometimes it's going to be taking more than the RRIF minimum. They're doing some TFSA contributions. But you can see that effective tax rate, 9-10% effective tax rate all the way through their life. Right? So that's one example of taking CPP at 65. Now let's use the same couple but defer to age 70 and pay attention to the withdrawal rates. If your memory, is going to be good to remember what that is. Don't worry, I'm going to give a summary after this so you can see visually what it is. And you see it's 9 to 10%. Here we are at age 70, same couple, and you can see that withdrawal rate is very different under the RSPs. The numbers are quite big. There's very little times where we're doing the RRIF minimum withdrawals, and the tax rate has gone from 9 to 10 to 10 to 11%. So they're paying a little bit more tax because the income is higher, and the withdrawal rate is a little bit more as well. So it's kind of interesting to see the nuances between taking it at 65 and taking it at age 70. Let's look at them side by side to compare. So you can see here the first column, CPP at age 70 versus CPP at 65. So let's look at the line by line. If you take CPP at 65, you will have a personal tax cumulative through, this is an example of these people right between now to the end of their life, they would have paid $36,000 less in personal income taxes had they have taken CPP at 65. And that makes sense, right? Because you're not getting the bonus that you would if you took CPP at 70, bonus meaning that increase, you're going to have less income and less taxable income as a result of it. So you're going to pay less tax. So that makes sense. Lifetime government benefits. Well, if you take CPP at 65, you'll receive $342,000 in this example. Okay, it's not necessarily you, but just so you can understand it, what it might mean for you, you would receive $342,000 less by taking the CPP at age 65. So you can see actually now, wait a minute, you start looking at saying, okay, we can save money on taxes if we take it at 65. But to do that, we have to concede that we're going to receive $342,000 less. Maybe that's not a good idea. So it starts to shape your thoughts as to what is a good thing. In either case, there's no clawback for this couple of their old age security. Now, when they pass away, if they take CPP at 65, you can see $241,000 they have in cash, meaning their investment accounts, which is $182,000 less as compared to if they took their CPP at age 70. Why is that? Because if they're taking CPP at 70, they have a 42% bonus increase to their CPP, which means they don't need to tap into their investment accounts as much, so they actually start saving more money as a result of that. And you can see their estate is actually higher by $182,000 is really the difference between not having to use up their money because of taking CPP at 65. They had a lower income and had to use more of their money. So it's a little bit of understanding how a nuance of CPP at 65 and 70, how that might affect you. We go through this with every single client, showing you what is the difference between that for you, so you can understand, make a decision basically on what you believe is the best decision for you. And we show you the math. Okay, let's look at healthcare. This is the fifth one. So what we really want to focus in on here is, what is the probability for you of having poor health in retirement? We don't know. Obviously, you know that. So you have to examine your own life, examine your brothers and sisters, your parents, and figuring out, is there a probability that you might experience similar kinds of health issues? If there is, do you need to make renovations to your home in order to remain in your home? Do you need some kind of care, somebody coming in to help you? Or would it be better for you to just sell and move to a place that it's already set up to be more accommodative for your health? So we go through that exercise in your planning. You have to do that if you're doing it yourself. You have to figure out, where are we going to live in retirement? How much is it going to cost? Is this going to be useful? Some of you have these plans, let's say, to move to a rural area, and it's further away from care, further away from hospital. So all that has to be factored in there as well. So it's something for you to consider. So this is an example of a plan where this couple is going to be spending time in a lifestyle community. Pretty simple. They want to retire and then have their in their later phase of their life, sell their home, downsize, all that money gets put into their financial assets, and all of a sudden they've got a large non-registered, as you can see there, as a result of selling their home, they got a large non-registered account that they're able to use in their retirement, also to help fund that lifestyle community. So we have all those things in plan so we can be flexible about what kind of planning you want to take care of. If you're doing this yourself, you have to go through the sort of the timelines as to when you need access to your income and how you're going to be living. Are you going to sell your home? Are you going to rent a place? Are you going to go to a lifestyle community? Are you going to renovate and stay in your home? All of those things have to be part of your plan. And what we do to help people make a decision about what they want to do is we show, if they wanted to remain in your home, here's one scenario about what you need to do and how much it might cost to stay in your home. And then we do another scenario where it says, well, what if you were actually to sell your home and go live somewhere else? What does that look like? And that way you get two different views of two wildly different scenarios for you to make a decision. So it's not us telling you what to do, it's us giving you options as to what life might look like when we do planning for you. How am I doing so far? Remember to hit that like button and share this video. Remember to hit that bell, because they've changed the algorithm on the YouTube channel. Our videos are no longer right in front of you. You actually have to go to the side where it says subscriptions and go to our channel to look. So they've changed that. So remember to hit that bell so you get notified of videos like this. Okay, one thing that is very common amongst retirees is you stop saving in retirement. For some reason, you think that it's all about spending out your accounts, but you ought to be thinking about saving. And as you get closer to retirement, you should be packing away that money into your investment accounts. We go into which accounts, of course, are the ones you should continue. So that first bullet point, continue saving in your retirement. So if you're 60 and you're going to retire at 62, save as much money those 2 years. If you're 55, keep saving as much as you can. Talk to your advisor about which accounts should you be depositing. Should you continue to make RRSP deposits? What about your tax-free savings account, your non-registered account, paying down debt, all these things. But simply focus on, do you have enough money and how much more do you need to save and where? And this is really important. Some people think that once you're retired, you can't, I don't know if you shouldn't, but I think they feel like they can't put money in a TFSA. Like there's some rule that says you can't be 75 years of age and still making TFSA contributions. Absolutely. If you have extra cash flow, put it to your tax-free savings account if you've got room. So let's look at what a plan, surprise, surprise, I'm sharing with you. Here's some examples. Here's the steps, and here's what it actually looks like when you do a plan. Okay. So on the left-hand side, you see this person is still working for 4 years. and they have, this is a combined income here, right? So they've got some money going in. Actually, this is not combined, this is one individual. And you can see the RSP. To my point about where do you save the money, we look at this person, they say they already have $1 million. One spouse has $1 million in an RSP already. Should they be putting more money in an RSP? This person did not have a tax-free savings account. So we said, enough of the RSPs, you need a tax-free savings account because it's actually going to be useful in your retirement for this particular couple. And you can see here the 4 remaining years that they're working, they don't make any RSP contributions, but they fully fund their tax-free savings account. And why is that important? Well, they've got a LIRA that's going to turn into a LIF, and they've got a non-registered account. So you can see the non-registered account, they're actually using some of that non-registered account to supplement their lifestyle spending, and then they run out of non-registered money, and now they've got their LIRA, which is then going to be a LIF at that point, and they have a TFSA. They didn't have a TFSA before, so they would only have an RSP to withdraw from, and that RSP, they'd have to make bigger, much larger RSP withdrawals, which would make their tax rate go higher. And when we calculate the difference between the tax rate of the withdrawal versus how much they would have saved in taxes by making the deposit, they were better off to go this way. So they're saving money by not making their RSP contribution, using their tax rate or their TFSA, allowing that TFSA to grow in value, and then at age 70, start supplementing their needs for income by using the TFSA. So it's a way to help lower their tax in retirement. So this is a perfect example of where we're looking at what accounts you should still continue to fund and which ones you shouldn't continue to fund. I hope that helps clear that up. I think it was a great example to share with you, and I hope you enjoy it. Okay, now we're going to move into portfolio management. There's a few slides in here to talk to you about how do you manage your money leading up to retirement. What are the things that you need to do very specifically to make sure that you're not going to be in jeopardy of saying, oh my goodness, we've had some 2 bad years of negative returns. Now I have to delay my retirement by a year. We don't want that to happen. So this is very important for you to see how useful this is. The first thing you want to do is you want to get a risk assessment done. This is a screenshot of the result of answering all those questions. So you may be familiar when you set up an RSP account, they asked you some questions, and then you came out at a balanced investor or conservative or aggressive. That's what this screen is showing you. So if you're interested and you want a tool that just to do a self-assessment, email me. I'm happy to send you this PDF document. You can do your own self-assessment. But essentially it comes out whether you're a balanced investor or very, very conservative or very, very growth oriented. And then okay, look at your current portfolio and see how is your risk today and how are you invested right now. It might very well be that you haven't done a risk assessment since when you first started your account. And as you're getting close to retirement, your risk probably is not the same way you were when you were 30. And so you might have to consider, do I need to be this risky going into retirement? So this is really useful for you to do this exercise before you go into retirement. The next is get a portfolio review done. I have this in many videos where I talk about the correlation matrix. This is a service that we provide. People send us their statements, their investment statements. We do basically a review, a portfolio review of your investment accounts. There's no cost to doing that. We just simply send you back, here you go, here's what we found out. If you want to have a conversation, we can talk about that. But basically the correlation matrix tells us how many of the funds or stocks or whatever you're investing in, ETFs, whatever you're invested in, how much correlation, meaning in one fund they have certain number of companies you're invested in, another fund you have the same or very similar. And this chart that you see down below where it's deep blue or light blue, you don't want to see very much of that on your portfolio. This is an example. This was a real life portfolio review that we did, 13 funds. So there was way too many funds, so over investing, too much diversification. That was one problem. And then the other part was that nearly everything was highly correlated into the 90%, 95%, which means what they invested in this fund, they also had in this fund, and this fund, and this fund, and this fund. It was all buying pretty much the same thing, wasting your money. You've got a fee when you have, whether you're paying to the advisor, it's in the funds themselves. And in this particular portfolio, they just bought 13 of the same kind of thing, which is bad. One fund goes down, the whole portfolio goes down. So send us your statements. We're happy to do this. Send it back to you so you can understand how your portfolio is put together so you can make changes. And we actually give you recommendations what to do. Of course, the next step in portfolio management is understanding, getting a plan done, and answering the big questions like, do I have enough money to retire? Will our money last throughout our lifetime? How much tax are we going to pay? What's the drawdown strategy? How am I going to withdraw all this money? I've got all these different kinds of income sources. How do I integrate that into the plan? You have an estate goal that you want to leave so much money behind. Maybe you don't. I've seen that too. How do you and when do you sell any rental properties and integrate that money coming into your plan? Get a financial plan done so that we can do all these things. Those slides that I was showing you are all from financial plans, so you can see the kind of varying types of plans that we do, and the people come out from that experience being very relaxed and confident about their retirement because they know exactly what they need to do next. Okay, so why do we suggest you do these things, the portfolio review and getting your risk tolerance done, getting a financial plan done? It's because we're trying to protect a few things here. One is called sequence of returns, and you can see here in a sequence of returns this red circle here. In this example, just real quickly, because I did a video just about this, but I'll just do the high points here, the main points. Each one of these returns are the same return after 10 years, 4.8%. Some go up in the beginning, some go down in the beginning, some are a straight line. Think of it like a GIC rate of return of 4.8%. That's that middle one. So if you had your money in there and it was for 10 years, after 10 years with the 4.8%, the blue line is $537,000. Now, if you had the light blue line where your first 2 years were positive returns, and then you had some down and some up and down again, they had $586,000. So its sequence is really important here. If your first 2 years of your retirement are negative returns, you're going to have less money later on in life. If you have the same 10-year return, 472 versus 537 versus 586. So the sequence of returns is extremely important. This is why when you go into retirement, you have a financial plan that says, here's how much money you have, here's the rate of return that you need to get in order to make sure that all your lifestyle goals are being met, and here's your withdrawal strategy. And that withdrawal strategy is going to protect you from sequence of return risk. So there is some method in the madness of advisors of what we're doing when we're trying to help you to prevent you from having less money later on in life. So that's called sequence of returns. We do this, one of the ways we can do this is through the 3 buckets. You can check out this video up here. It's all about the 3 buckets. You have the first bucket, real fast, you have the first bucket on your left, bottom left-hand side. That's your lifestyle spending, 1 to 3 years, buying clothes, groceries, going out for dinner, putting gas in the car, property taxes. And so you would take all of your lifestyle expenses, and it's basically in cash or a laddered GIC, money market, and you have zero volatility there. So you can know that depending on your risk and timeline, if you had anywhere from 1 to 3 years in cash of all your expenses, during that time, you can go and do what you want to do, and you don't have to sacrifice any of your lifestyle. The middle bucket is really designed to, the whole thing is a waterfall effect. So the middle bucket is going to replenish the first bucket after you have depleted that money. So the middle bucket is in sort of like middle of the road returns, and you have a 4 to 10 year sort of horizon, if you will. So when you're doing your risk tolerance assessment, you say, for how long will you keep this money in this if this happens? Well, we're putting them in these silos, these 3 different buckets. So when you answer your question about risk tolerance, this is its own risk tolerance. So you're saying, okay, I'm going to need this money in 4 to 10 years. If I have a timeline of 4 to 10 years, what kind of investments are appropriate in that timeline versus something I'm not going to need for 11 to 25 years? So they have their own risk tolerances, and their investments are vastly different. Okay, and essentially, it's a waterfall effect where you're just filling up the buckets with the money so that you can replenish it after. And this can assure you your money is going to last throughout your lifetime, and you're not going to have these feelings of running out of money. It's pretty simple. Okay, withdrawal strategy. So your withdrawal strategy is going to affect three things in your plan: your income, your tax rate, and your estate values. That's really the big three that you have to be aware of. Whatever you're going to decide on how much you're going to take out of one account versus another account is going to affect three, I call them levers. Think of like a dimmer switch up and down, right? When you say, okay, increase the withdrawal here on the RSP account, that increases your tax rate, and it's going to do what to your estate value, right? So this is why we have to be aware of when you are designing your withdrawal strategy. There are three things that's going to be affected every single time. So let's look at that in an example. Here we have the RSP on the right-hand side, and you have a spousal RSP on the right-hand side. We're doing a withdrawal strategy. You can see that sometimes it's 70,000 or 75,000, then 80, 65, 70. It's up and down because we are trying to get the money out by a certain age. Usually I try to get money out of someone's RSP by 85, 86, somewhere around there, right? That's the average mortality in Canada. And if that's the case, then we're looking at the effective tax rate, and you can see it's 18 to 19% in this case for this couple. So in this way, we're being aware of when we do a higher withdrawal in the RSP, we know that the tax rate's going to come up. So we're paying attention. What are we trying to have? We're having the best balance of a tax rate, effective tax rate, and a withdrawal with a timeline. We got to make sure that we get it out by a certain time, because after all, many of you are saying you do not want to pass away with money in your RSP accounts. So this is what you have to do if you don't have an advisor and you don't have a plan done and you're doing yourself. You have to be thinking, okay, every year, line by line, what's my rate of return? How much has that grown to? Now, how much can I take it out? What's the tax rate? There's a lot of moving parts. Just get somebody that's got the software like this and years of experience to be able to do this for you and have these great conversations about your retirement. And I guarantee you're going to love getting a plan done because we have a lot of fun doing it. We get to explore a whole wide variety of choices that you probably thought might have been out of reach. So I encourage you to contact us when you're ready for that. And the last one is tax planning. Tax planning is really important. I would say almost nearly everybody. There's some people say, I don't care how much tax we're going to pay. We just want to enjoy our money, get that money in our hands as best as you can, but tax is not on our mind. And then there are people that say, no, I want to pay the least amount of tax. Give me a tax efficient plan. No problem, we can do that. So what are some of the tax planning areas that we go into? Pension income splitting if you're married, if you have a spouse. The withdrawal order, such as, okay, do we take money out of an RSP first, out of a TFSA, at a non-registered account? We've got a LIF, we've got restricted share units, all these things coming in here. Where are we taking money out? So we've developed that withdrawal strategy. If you've got a LIF that has to be converted to, or a LIRA converted to a LIF, and then 50% unlocking, if you're one of the lucky people that live in a province that allows you to do that, because there are a couple provinces that do not allow you to do that, you may want to give some money like to your kids, for instance, while you're living. You want to continue TFSA deposits. As you have money in a non-registered account, you shift that into your TFSA every year, try to save some money in taxation. And if you are using whole life insurance to defer, meaning when you put money into non-registered account, you can watch this video up here. Is it up here? I can't remember. When you deposit money into life insurance and that grows tax sheltered, it allows to compound on itself. And then if you wanted to use it later on in life, you'd be pulling that out tax-free. It's a really great way to save on taxes, because the money that you would pull out of, the money that you deposited to the life insurance is no longer in your non-registered account, so it's not being taxed. So that wouldn't have a drawback on your old age security, because there's less money there to be taxed. So it's saving the clawback in your old age security. And then when you take the money later on in life, if you want to take the money from the life insurance on a tax-free basis, it's tax-free, so it's not going to affect a clawback on old age security. So all these things we go into and more to help you with tax planning. Well done. You made it to the very end of the video. Thanks for sticking around. one question for you, okay, as I always do. What is your biggest retirement blind spot? When it comes to retirement and you're trying to think about what do you know, what don't you know, what is the area where you're trying to plan for retirement but you just don't see X, or you know it exists but you just can't figure it out? What is that blind spot? Put in your comments. Everybody likes to read comments, as I do. And I appreciate you being here to the end. And I look forward to seeing you in the next video. Thanks, and be well.